when it first turned up in kind of April, May, June, even July 2021, you could say, and there was good support for it, that a significant part of it were what are called base effects. And you have to know how they calculate inflation. How does the government do it? They look at the monthly data and they compare it to the same month the year before. So it's a year-over-year comparison, but only for 1 month. Then they take that number and they annualize it. So whatever it is, they times 12, or there's a little more to the math, but basically they annualize that, and that's the number you read about in the headlines. Well, if you say, okay, April, May, June 2021 were hot, well, what was going on in April, May, June of 2020? Because that was the comparison. Well, the economy has shut down. I mean, literally shut down. The worst collapse since 1946, and one of the worst in American history. So we didn't just have low inflation in 2020, we had deflation. Prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to go up. Of course that was going to be more than usual. That was completely expected. It's hard to disentangle what I just described as the base effect from it's called real inflation, real price increases. But the best estimates were about half of it was a base effect. So if you were seeing a number of 6% inflation, that was about what it was. You could say, well, it's kind of 3 real and 3 base effects because we're comparing to a very weak year. However, as you got into August, September, October, the base effects started to go away, which is, you say, well, what was going on in August, September, October 2020? Well, that was one of the strongest periods of growth in U.S. history. That was the other side. It went down and then it came back up. It didn't make it all the way back up, but yeah, that was a strong rebound in the third quarter of 2020. So you would expect, so therefore the base effects went away, but the inflation remained hot. It didn't fade as much as I thought it would. It was like, okay, well, the base effects are gone, but the inflation is still there. In fact, by some measures, it's even worse. So here we are early in 2022, and as of the most recent data, we don't have the December data yet, but we have November data, and we have some other indicators, and it's still a little bit hot. So now we're at a point where you say, okay, is this real inflation? I would define real inflation not just as numbers, but is it persistent? Is it pervasive? Is it across the board? Is it feeding on itself? Is it raising expectations? That's something to worry about. Or are there some specific causes we can point to and say, yeah, okay, that's causing a little inflation, but it's going to go away. So that's the debate. It's the biggest debate in economics right now. I'll give you my view, but I'll be clear that there are definitely two sides of the coin, no pun intended, but definitely two sides to the debate. And in particular, you say, okay, let's disaggregate a little bit. Yeah, the numbers have been hot, but what's driving it? Well, one of the number one things are energy prices. Well, okay, but what was Biden's energy policy from the day he was sworn in? He shut down the Keystone XL pipeline. He handicapped fracking in Texas and Pennsylvania and other states. He prohibited new oil and gas leases on federal lands. He limited offshore drilling. And he did a number of other things, all of which were designed to basically handicap the oil and natural gas industry. So my point is, energy is real. You need it. I fill my tank just like everybody else. I'm not immune to this. Used cars. But when you have a couple of things like that are driving the whole CPI, you have to step back and say, wait a second, is this widespread inflation? Are expectations changing? Is this sustainable? Or is this just a short-term spike in a couple of key indicators? Rental equivalent housing is another one. There's a housing shortage because, zoning requirements, and BlackRock's buying up all the houses, and there are other reasons for that. And so as I look at it, what I see is, the inflation numbers are up. There's no question about it. But this is not the kind of inflation we had in the 1970s. This is not that kind of inflation. In the 70s, it was everything. It changed expectations. It was what's called cost push inflation, which is workers are like, well, you got to give me a raise, and unions were stronger, but even non-union companies said, yeah, I do, actually. That's not true today. Workers don't have the bargaining power. Labor force participation is low. And like I say, it looks like a couple factors that are going to run out of steam, and the economy is slowing, and we kind of can get into the whole supply chain debate. So just to sum up, I would look for disinflation. I'm not calling for deflation. Deflation is when prices go down. I can't rule that out, but I don't see that. That's not my intermediate term forecast. But disinflation is. I see these numbers going down from 6%, 7% annualized, which is what the government's showing. That's where it's heading again. So not deflation, but disinflation. This inflation bubble is going to go away.